All right, folks, welcome to this month's episode of Navigating the Markets. The topic is one on all of our minds. Where do we go from here? And I'm going to try to talk through that with a number of different charts, talk about some of the opportunities that I see building here as well. And I really think that in this market, even though it seems like we've had this big run from the lows, which it has been historic, there are still opportunities out there on the long side of things. So we're going to talk about that as well as some of the risks that I see building here. But first, no presentation is complete without the risk disclosure. So please do be careful about how you manage yours. We want you to be able to come back the next day, the next week, the next month, the next year, keep trading, keep investing. That's what it's all about. Run it like a business. A bit about me, I've been doing this for 20 years. I know that ages me, but I also cut my teeth during the great financial crisis, which was a really interesting time to learn how to trade. It helped me prioritize risk management first and foremost, which is something a lot of folks kind of learn later on, sometimes by hurting themselves or blowing up an account. For me, it was more seeing the world's financial system begin to crumble before my very eyes and appreciating just how tenuous things can be and realizing that when we allocate capital, it's really important to appreciate that we may not get that all back if we're on the wrong side of that investment or trade. I know that seems obvious, but sometimes in the moment, when we get excited and we have that sure thing lined up, it may not seem quite as obvious then if emotions are in the driver's seat. That's also why I lean more into systematic trading. Keeps me honest. We can all let our emotions kind of take the driver's seat. And to some degree, discretionary trading is a bit of that. There's a bit of gut feel. There's a bit of emotion. It's more psychologically driven. I've leaned more and more into a systematic approach. That's also why I've built a lot of the tools that we enjoy in the Traderade community. Because for my own trading, it both saves me time, but also keeps my emotions in check, right? No matter what I feel about the market, if the flow is telling me something else, I'm going to have to fade my feelings and follow the flow. It's just how it is, especially in an environment like this. So that little nugget of wisdom that I'm trying to imbue upon you is if what you're doing right now isn't working for you, if you're finding your emotions are getting in the way, I think it's a good time to take a more data-driven, momentum-driven approach. Consider it. Let's look at what's going on around the markets. Today we had a pretty interesting trading day. It was largely dominated by parts of tech. One reason why the Nasdaq was showing relative strength versus the S&P 500. But it wasn't every part of tech celebrating. There were some noteworthy exceptions, Tesla being one of them, Palantir, crowd favorite, being another one. Speaking of crowd favorites, CrowdStrike also getting nailed a little bit there after somewhat disappointing earnings results. But overall, tech was where most of the green lay in this heat map today. There was some weakness in energy, utilities, financials, consumer defensives. So you could see there was that continued rotation into technology stocks, something that Goldman and some of the other banks think may be an ongoing theme. And we'll talk about why in just a moment. But first, here's a fun one. If there's no sell in May, there's no need to go away. When we see May close with a 5% or higher return, typically we see strong returns in the following 12 months. So this goes against the old adage, sell in May, go away. And certainly at the beginning of May, it was looking a little more tenuous. Was that relief bounce, that V-shaped bottom going to give way to a new low? A lot of it had to do with the policy and the uncertainty surrounding that policy. And what we found more and more is markets aptly leaned into the taco trade. It's been the talk of the town. Taco being Trump, always chickens out. It really doesn't matter what your politics are. Actions speak louder than words. And we've seen this get to the point now where the markets just seem to discount whatever Trump is saying readily. So the headline hits the tape. The high frequency trading algorithms parse it, take it at face value. And then their handlers and other traders come in and say, yeah, you know what? We're actually going to take the other side of that. We don't really believe this outcome because we've been given no reason to believe in this outcome. And if we go back to Liberation Day, which, by the way, didn't even last a whole day, I think we can see why. There's a propensity to U-turn on these things so quickly that a lot of the folks that are allocating capital simply don't have time to sit around and try to figure out, does he mean it this time? They're just going to assume he doesn't mean it until proven otherwise. And so far that worked in May. And if we look back at prior Mays that returned 5% or more, we can see that tends to lead to an average of almost a 20% return over the following 12 months. Is this time going to be different? It's anyone's guess, but this at least gives us a little bit of statistical data to color our view. And when we look at that recovery from the lows in April, it's been led by some familiar faces: Nvidia, Microsoft, Apple, Broadcom, Tesla, Amazon, Meta, Alphabet, Netflix. And of course, you got to have at least one non-tech in the mix, right? So there's JP Morgan. But this is also something that I think leads us into the next part of this thought process. Is tech's rally done? I'm not so sure. There's a lot of signs that point otherwise. But before we get into that, really quickly, just want to show an incredible chart. I shared this on the Traderade Discord earlier today. But for us retail folks, and I'm pretty sure just about everyone out there watching, listening, are among us, retail. We just had the biggest first quarter or biggest quarter ever of 0DTE options volume. And this is pretty incredible. This is over 1 million in just SPX alone. And we're outpacing institutional traders in that volume as well. So retail really is becoming a much more formidable part of this market. And where did that ultimate handoff happen? It looks like around Q2 of 2021, us retail folks were trading more total volume than institutions. And that gap continued to grow until now, where it's over 1 million contracts traded in a quarter. So kudos to us for sort of wresting control away from the institutions. And by the way, hedge funds have been on the wrong side of a lot of this stuff. They're not the only participants on the institutional side, but they're certainly a big, important part of it. And it's one reason we've seen a lot of the crazy price action that's been taking place over the past couple of weeks, especially in some of these heavily shorted stocks. So something else to color our thoughts as we move ahead here. Also, market breadth. This is a familiar chart. It's not inherently bearish. It's just something to keep in mind. Breadth is really low here. What that tells us is, going back to that prior stock chart of where the leadership was, there's really only 12, 15 names doing most of the heavy lifting here. And of course, they're the largest names. They're doing a lot of work to pull this market higher. There's a lot of other areas that aren't performing the same way. So that is leading us to pretty narrow breadth. Now, the tail risk from that is if any of these Mag 7 stocks have a serious problem and that leads to sympathy selling in the space, then that can bring the market down more appreciably because there's more concentration of risk. So the chart itself is not inherently bearish, but it does give us a sense that at the very least, we should be mindful of the concentration of risk here in those really, really, really large companies. And the dollar short position, this is something I think is way overdone. This gets me kind of bullish on the dollar, especially if rates continue to push higher. But the dollar short position is close to the highest since 2023. Now, we're to imagine that folks are buying euro, they're buying yen. In fact, yen long positioning is extraordinarily stretched here. I think there's some trades in this. I've shared some of those thoughts on the Discord, but suffice it to say, I'm not bearish on the dollar here, not after this kind of positioning. If anything, the contrarian me looks at this chart and says, I want to look at setups that benefit from a rebound in the dollar, including direct positioning long dollar, but also fading some of those crowded areas like the yen, for example, where the Bank of Japan isn't going to be hiking with the long end running away, as it is, in my opinion. I don't think they have a choice. And that means they're more also likely to get back into that phase of trying to intervene. In fact, they've already made noises about intervening in their treasury market. So, if anything, I think the yen's got some room lower. And I think that any kind of fiscal or monetary policy over in Japan that helps them with trying to control yields is going to be deleterious for the yen, as we've seen in prior years. Let's talk a little bit of technical analysis here. There's a lot going on that I want to cover. We've got like over 40 slides here. I'm going to get through them quickly, but also cover the details with each one. And then as we get through them, we'll get to Q&A. So if you have any questions, share them, and I'll get to them towards the end of the presentation. Now, this is one of my favorite charts, and you guys know why if you've been watching me for a bit. I love Bollinger Band squeeze breakouts. Anything that's driven by momentum, this is the type of analysis that so rarely gets shared and yet can be so impactful for capturing momentum. We talked about systematic trading. This is it right here on screen. Because what we're seeing here is an undeniable compression of volatility and price range. That's the Bollinger Band width up top. You can also see it here in the box I drew. And when that band squeeze expands, you have what's called a Bollinger Band squeeze breakout. And that breakout tends to lead to really powerful momentum with room for continuation. It is not necessarily directional. So just because you see a squeeze doesn't mean, boy, I better get long. There's also not a specific timetable to it. That is to say, you need to wait for the breakout to show you the direction. And when that breakout is happening, gives you a sense as to when it may be time to start scaling into some of those positions. So with gold, this is something I was sharing on Traderade as it was happening in like mid 2024, saying, I think gold's about to go on a big run. We've caught a big chunk of that in a variety of different ways, whether it was exposure to gold directly in the futures or ETFs, or in some of the mining proxies like the GDX, which we recently had a great trade in, or some of the junior stocks like Rio 2, which is a junior miner that is up about 50% from February, where we shared it as a long-term investment idea. And I still think this space has room to run. But I'm more excited about some of the other areas in proximity of gold. That's not to say this can't keep going. I think gold probably hits $4,000 by the end of this year or maybe early next year. Gold, to me, is an uncertainty hedge. I like to look at gold as a way of hedging against policy, geopolitical, and economic uncertainty, because it's much better at doing that than acting as a hedge against inflation. For taking an honest accounting of gold's past performance, that's what it does best. And so when we're looking at this back to the squeeze breakout, what tells you you're still breaking out is you have this increase in bandwidth. There'll be periods of consolidation, but overall an increase in bandwidth, and you're hugging the top band. I know some folks look at the top Bollinger Band and they say, gee, you know, that's resistance. I want to fade that. That might be true in a consolidation. If you're going sideways and bandwidth is pretty static, you can fade the top and long the bottom and whatever, trade that chop. But if you are in a volatility expansion period, the opposite is true. You want to actually be longing into those tops because it keeps expanding and growing, and you see price almost magnetically attracted to that top band, as it has been for practically this entire breakout here. And on the other side of it, to manage risk in something like this, it's very easy. I actually look at the 50-week moving average. So this is a very easy chart to make. It's a Bollinger Band, 50 period on a weekly chart with a 2.1 standard deviation. And then, if you'd like, toss the bandwidth on top so you can view that separately, just so you have that indicator. And you can apply this to a number of different asset classes that trade driven by momentum. And I'm sure you're already thinking about the one I'm going to share next. But quickly, before we go there, let's just look at these pivots. This is part of the Traderade dynamic pivots. These are some of the pivots I'm working on now for commodities, and they're pretty cool. They've been really helpful in navigating some of these moves. So right now, for gold's uptrend to really look healthy to me, I need it to stay above 3270.20. As long as it's above 3270.20, I'm still inclined to think we can get back to those all-time highs and probably exceed them. If we're not able to hold above there, I think we go back into a period of consolidation. So that's one thing to consider when looking at gold. It's still in that uptrend. It's sort of doing a bit of consolidation now, but it's starting to look a lot more constructive. So I do think the path of least resistance is higher for gold. Another one with these Bollinger Band squeeze breakouts is none other than Bitcoin. And if you think about Bitcoin, I'm not going to try to draw any parallels with gold here, other than it is really a momentum-driven trading vehicle. That is the biggest thing that Bitcoin trades off of, because like gold, you can't really value it. So it's just momentum and psychology. And as a result, this squeeze in Bitcoin, which happened a little earlier than gold, led to a rather prolific breakout to all-time highs. It's the same kind of chart. You're really looking for a squeeze and a breakout, right? So you got a really nice squeeze here, and then you had a breakout. We continue to hug that upper band. So this is the same chart. 50 period on a weekly chart, 2.1 standard deviation Bollinger Bands, and look at how well that 50-week moving average helps you to manage risk. As long as you stay above that average on a weekly closing basis, there's no reason to get out of the position. So since this breakout happened, there's been no reason to sell Bitcoin. It's just that easy. You just have to zoom out to the swing time frame. I know we can get caught up in the day-to-day, and that's fine. That's a perfectly valid time frame to trade. But I think that some of the biggest opportunities we're going to catch are on swing trades that we kind of set and forget. Like if this thing doesn't crack the 50-week on a closing basis, I have no reason to want to get out of it. In fact, those tests that become reversals are great areas to add to a long. And for Bitcoin, I'm looking at 100,810. It needs to hold above that, or I'm tempted to think it looks more like it's going to consolidate for a while. It doesn't mean the bull case is completely dead. It just means it's more likely to chop sideways until it breaks back above. So 100,810 is that pivot on Bitcoin. Now, what momentum-driven trading strategy with things like gold and Bitcoin would be complete without a look at silver? And silver is starting to look like it's ready to go. I do want to see some better band expansion because we're starting to squeeze a bit here, but we can see the prior squeeze and breakout led to a pretty big move higher. So I'm looking for band expansion, continuing to hug the upper band, holding above the 50-week moving average on a closing basis. And I think silver could be the next one of this trifecta to run. Silver typically lags gold a bit. Often in these rallies, it eventually plays catch up. And I think the secret sauce for this trade is that silver needs to see some big stimulus from China. I really think that's the missing piece for silver's performance. If we see some bigger stimulus domestic in China, I believe that silver is going to run pretty significantly. And you might say, but Mayhem, why? What does China have to do with this? Well, China is the second biggest industrial user of silver on Earth. So if they start really going back into domestic stimulus, trying to rebuild domestic consumption trends, silver usage is likely to get much bigger. And one of the areas that'd be interesting to see stimulus there is also solar power, because solar power uses a decent amount of silver as well. It is the best conductor on Earth, after all. So for silver, for me to get more excited, I want to see it break above 34.47. That's where I think we've got some serious room for multi-year highs. Right now, it's consolidating, and it has been consolidating for about 2 months. But overall, the structural picture for silver, both on a supply-demand basis and a technical basis, looks pretty constructive. I just want to see that breakout from 34.47, and then I'm going to be looking for more longs in this space and in some of the companies in the space as well. And finally, a teaser, one that's setting up, palladium. Look at this thing. It's been setting up this squeeze for almost a year now. Whichever way this thing moves, and the longer it coils up, it's going to be a big move. I'm inclined to think it's likely higher, but again, I need to see the bands expand and the breakout start. I'm not going to try to be smarter than the market. I'm not going to try to front run my own strategies. I'm going to be patient because what we have on our side as retail traders, what gives us a distinct advantage in the markets is one simple thing. We don't move the markets. We move with the markets. We don't trade enough size that we're going to have an impact on the S&P 500, which is good because that means we can get in and out of positions at the blink of an eye, which is an agility that institutions simply do not have. We need to cherish that and use that to our advantage. The fact that we can come and go as we please, getting in and out of positions as we feel the need to do so, as our systems tell us it's appropriate to do so without moving the markets, makes it so much easier to be agile. A lot of these bigger trading desks, they have to use icebergs. They have to use strategies that get them in and out of positions over the course of days, weeks, and months. We can do that in a matter of minutes a lot of the time, if not seconds. That's a huge advantage to lean into. Let's talk a little bit about what's going on in options with a focus on the S&P 500. So first, 6,000 remains the biggest level to watch on the chain, and you can see why. Look at all this positioning up here. I think it's likely that we test that level. And if we do, because of the amount of positioning up there being such a large level of gamma exposure, I think we'll probably get stuck there for a bit. These really large gamma levels, they tend to be kind of magnetic instead of just being a support and resistance. And there is a wall of calls at 6,000 as well. You can kind of see that in the delta between puts and calls favoring the calls. But overall, it's a huge area of interest on both sides of the chain. When that happens, when you see those big gamma levels, they tend to just kind of pull you in. So I wouldn't be too surprised if we kind of get pulled into S&P 6,000 as we get into OPEX and kind of just get glued by all that gamma exposure until post OPEX. That's kind of what I would be looking for. It doesn't mean obviously that that's going to be what happens. We do have a situation where headlines, if they're to be believed, can move the markets pretty big if they're credible. Now, some key S&P 500 options levels to watch. We have 6,100. That's the second largest area of net call exposure. 6,000 is the largest area of net call exposure. That's the call wall. We have gamma 1 and then the vol trigger and the put wall. And I realize now I mislabeled gamma 1. That's actually the gamma flip. So imagine that as your gamma flip level. Basically meaning if we pull below that, we are going into negative gamma. Right now, we're in positive gamma, which is vol suppressing. That means dealers are more likely to sell rips and buy dips, and that tends to reduce the potential for that chase dynamic, which happens in negative gamma, where dips are sold and rips are bought, and it can get a lot more fluid intraday. There's also a big amount of positioning down lower at S&P 5,600, where there's been a lot of hedging pressure. In fact, we can see that on the skew chart. Hedging demand is starting to rise in the S&P 500 ahead of June OPEX, which, if you're looking for those early and late day flows that tend to bid the market up, those Vanna flows especially, this helps to add a little more juice there. Obviously, it would be better if skew was quite a bit higher, but it's still high enough that you will see some of those flows as we approach OPEX, and particularly OPEX week. They'll be more pronounced because those hedges are losing value, so dealers are essentially able to have less exposure to maintain those hedges. So as they're doing that, as they're removing those hedges, that's liquidity positive. For example, if you're a market maker and you're selling someone puts, you're hedging that by selling short some S&P futures to neutralize your delta. So you have no actual exposure to that contract. That way you can pay it out if your client's right and you don't take a loss. But as that contract loses value, as its delta drops, you also don't have to keep the same level of hedges on, which becomes liquidity positive. And you contextualize it very simply. The skew on the S&P 500 has leaned towards puts since after the 1987 crash for one simple reason. The way that we manage risk has evolved. And that in turn means there's always some degree of excess on puts in the S&P 500 index options versus calls. And the amount of excess in puts versus calls is what helps to define how much of those constructive flows we may see approaching options expiration. Now let's zoom out a bit, take a look at the big picture, and then we're going to talk about some opportunities. This has been really interesting. And I've shared this chart. It made the rounds on social. But one of the reasons that we're seeing so much excitement in some of these beaten down, I mean, there's really no better term for them than shitcos, because these are companies that don't make money. They may never make money. They often end up diluting their shareholders pretty badly, but they tend to become crowded hedge fund short favorites. So that's something to take into consideration, because gross exposure right now is about the highest it's ever been. And this is a pretty big concern if you're a risk manager at a hedge fund and you see these shorts ripping higher and you've got incredible leverage on, you're likely to tap those traders on the shoulder and say, you need to degross. You need to flatten out some of these books. This is too much. You have too much exposure. So one of the reasons those short squeezes are happening isn't just there's demand for the lowest quality stocks out there, that there's some, level of euphoria out there. And there is, but there's another side of it. And that's that these guys are super crowded in these shorts. So when you see things like Bitcoin miners that don't make money running, quantum computing companies that don't make money and may not survive the next 5 years running, and a bunch of other things like that, they usually share a few common traits. One, they have high short interest, usually above 20%. Two, they have a relatively small float, usually below 100 million in the float. And three, they have volume dynamics that suggest that short squeeze could play out for some period of time, usually days or weeks. Then you look for the catalyst. Is it a headline? Is it flow? Is it some combination of the two? So what I like to do in periods like this is make a list of companies that are highly shorted, that could have catalysts coming up, that have pretty decent looking charts, and share them on the Discord, which I did today with 4 of these short squeeze opportunities, exclusively available for Traderade members in the stocks and options channel, that you can look for to get a better sense as to where there might be some opportunities if these squeezes really do play out. And we've had this happen with relative regularity, because for whatever reason, hedge funds, to manage their books, they all kind of get crowded into the same shorts and into the same longs. It's hard to call yourself a hedge fund if you're not actually hedging. I just have to put that out there. It's not only that they perpetually tend to underperform the S&P, it's that, the name is a bit disingenuous if you're all shorting the same crap and you're all long the same good companies. So if you're really going to hedge your delta, you would be shorting stocks in the same factor that you're long, in the same group. So if you're long mega caps, you'd be short something like that. But instead, they're long mega caps and short shitcos, and that's why we get these periodic episodes of shitco surges. Another thing that's interesting, and this lends credence to the idea that some of these Mag 7 stocks could have room to run from here. The earnings surprises that we saw during Q1 were the greatest that we've seen since Q3 2023. So a lot of folks going into this earnings season were looking for the Mag 7 to be a bit underwhelming. And of course, if you do look at things like Tesla, they were. Not that that matters to that stock because it trades inverse to fundamentals. But for the rest of the Mag 7, overall, there were some decent upside surprises. And that could set up some of these stocks for continuation over the summer. And guess who's jumping on board with that? Our favorite friends over there in hedge fund land did the biggest buying of US tech stocks from May 23rd to May 29th last week that they had done since basically late 2022, early 2023. This was a huge amount of buying, and they're still underallocated. That's the interesting part. This looks really impressive. Like, boy, they must have been getting, pretty eye-hole deep in tech exposure. No, actually, they're still near multi-year lows of tech exposure. That is to say, there's still a lot of buying back to do if they feel like this trend is set to continue. And you look at the systematic funds. These are things like CTAs, risk parity, vol control funds. They absolutely puked their longs out over the beginning of this year into that April low. And they've only modestly re-added that exposure. Now, as realized volatility fades, and it is, especially over 60 and 90-day periods, you're going to see these folks want to get long more exposure. So that's another area where you could have liquidity coming in. Add to it, you've also got record buyback authorizations that are likely to lead to record actual buybacks. So that's another thing to keep in mind. Now that we're kind of out of peak earnings season, and we have been for some time, that liquidity, which is, by the way, the largest driver of share accumulation in the markets, buybacks, it's back in full effect. And it's one of the reasons that we tend to get really interesting flows in the first and last half hour of the day. That cross current of institutional flow, of which in no small part, buybacks are a part of that. Now, I know there's been a lot of talk about, where do we go if we're not going to invest in the United States? And by the way, I do have some ideas about that as well that I will share, but I'll also say the United States remains a premier destination for investors. Yes, we have a lot of crazy stuff happening in policy, in our politics and otherwise, but that doesn't take away from the fact that this is the only country on earth that has more than 1,000 companies valued at over $1 billion. In fact, it's 1,873, which is about a third of those types of companies on earth in a country that has 4% of the world's population. It's pretty incredible. And yes, I realize the S&P 500 has a lot of international revenue and there's a lot of other factors that go into this. Nevertheless, that doesn't take away from the fact that the United States is still a premier destination for investors domestically and globally. But we do have some issues we have to confront, both here and abroad. One of them is that developed economies especially, and I do consider China in that mix. In my mind, China is not an emerging market, and they haven't been for some time. Emerging markets don't typically tend to build cities, knock them down, and then build new ones on top to pad GDP, because they're emerging, so they have all kinds of factors that actually grow their economy organically. So I would argue China is a developed economy. It fits into this matrix. Nevertheless, developed economies are addicted to debt, and that is creating uncertainty, both abroad and here at home. And with the bills that are being proposed here to eliminate a debt ceiling, to ramp up the debt, to cut taxes, and then eventually maybe cut spending a little bit, and we'll see that in a little bit here, this is all probably one of the reasons that the bond market is having a pretty bad time. Obviously, the policy uncertainty doesn't help, but the big picture is if you're going to go out on the duration spectrum, buying U.S. Treasuries, above 5 years maturity, you have to have some confidence that the budget's not going to go off the rails, leading to depreciation of the dollar in excess of whatever your cumulative yield is in that exposure. This is a really important point to consider for fixed income investors. And it's one reason why for the past year plus, I've been of the mind that we would have a bear steepener because you're not getting paid the term premium you should going further out on duration. What does that mean? It means I should be getting paid appreciably more to take 30 years of risk than I am to take 2 years of risk. And it's what? A variance of 120, 130 bips or something like that. It's not enough. There's appreciably more risk going out further on that yield curve because we can count on debasement and we can count on silly runaway deficit spending because no matter who's in power, they're all doing that sort of thing. To one degree or another, we have debt that continues to move up and to the right on that chart. In fact, now we've gotten to the point where Trump is saying he just wants to scrap the debt ceiling altogether. And, sounds very fiscally conservative, but that's one of the things that gets the bond market concerned. Add to it, this is what the so-called big beautiful bill, which has now become Elon Musk's punching bag, this is what it is projected to do based on Goldman Sachs's analysis. You're going to have front-loaded spending, back-loaded spending cuts. Basically, the cuts start to really come into play later than anyone's really even going to remember that this was the cause. So you look at that from 2028 on, basically when his term's over, that's where most of the cuts start to hit. So in my mind, I look at this and say, this is another reason why the bond market's not happy. They don't want to see tax cuts and then spending cuts. They want to see spending cuts that allow you to justify tax cuts if you can justify them at all. Now, yes, the government has a spending problem. It spends like a drunken sailor. It should be cutting down areas of bloat pragmatically. One area, if I had a choice in the matter, I would look at the DoD. I remember famously on September 10th of 2001, then Defense Secretary Donald Rumsfeld said that the Department of Defense cannot account for $1 out of $3 spent. Obviously, the next day 9/11 happened and everyone forgot all about that and our defense budget ballooned. Now, I think it's authorized or we're looking at over $1 trillion of spend for fiscal year 2026. And to think that about a third of that is likely still money they can't account for and likely could be saved if there was a transparent audit of the Pentagon, that's one area of low-hanging fruit. And there's plenty more around different parts of the government if we actually had folks that were determined to cut spending, didn't have conflicts of interest, and really wanted to get the job done. Unfortunately, that's not what we have, and neither party offers that. There is no fiscally conservative party in the United States. It's just an honest accounting of the situation. And that's one reason why the long end deserves a larger term premium and why I think we could still have that bear steepener. And what a bear steepener is when the long end yields move up more than the short end. It's that simple. And it doesn't necessarily have to have a negative implication on the stock market, but eventually if yields move fast enough, that's where I get much more concerned. And also if the 10-year starts to push meaningfully above 4.5%, that tends to add some pressure into risk too. There are reasons for that. There's over $100 trillion of global debt that key off 10-year note interest rates. So as that rate goes up, it has a de facto impact of tightening liquidity. You have to pay more money in the interest on your debt, so you've got less money for other things. That has a global economic impact. So the rate at which interest rates move is important, as is some of these key levels, especially on a global benchmark like the 10-year note. Speaking of rates, the real rates on the U.S. 30-year bond have reached the highest level since November 2008. So again, the bond market's sending us a message. Now, I don't think this has anything to do with, oh God, we're all going to die. There's a financial crisis coming. It's going to wipe us all out like the great financial crisis. I'm not reading into it like that at all. I'm more reading it into like people are looking at the long end and saying, I deserve more premium here because I think I'm going to be debased out of a lot of what I would earn if I accepted current yields. So I'm still of the mind, again, bear steepener. I'm not really interested in long bonds or even long duration notes like 10s. If I want fixed income, I'm much more likely to want to have bills and very short dated notes, like maybe a 2-year, and then some of the tax-free muni bonds in AAA rated localities. Those are the only real areas of fixed income I'm very, very interested in. Some of the AAA corporate debt could be interesting too. But outside of that, a lot of the lower tier debt is priced in a way where if anything untoward happens, you're going to be underwater. There's really not a lot of discounts out there. Spreads are still very narrow. To me, that indicates some degree of complacency as well. But one place there isn't complacency, credit default swaps. 1-year credit default swaps on U.S. government debt have been rising quite a bit off their lows. And again, this is an expression of policy uncertainty and some degree of a lack of confidence that we'll be able to get enough tax receipts to be able to balance out what we owe. Now, obviously, the government has other levers it can pull. There's that regressive inflation tax, debasing the dollar, getting into deficit spending that helps to bring up tax receipts, and obviously it becomes a vicious cycle. We've seen a lot of that since COVID. But now it's starting to hit a point where it's creating more concern such that investors are insuring against that risk. A credit default swap is essentially an insurance policy that you buy against default risk. So it's kind of alarming to see that rising, that interest rising on insuring against default risk in the United States. So again, something to keep in the back of your head as to why some of those long end yields especially could have room to continue rising. And let's look around the world as to where we don't want to be right now. One place I don't want to be right now is Europe. They still have a lot of economic headwinds. I think that if we look at seasonality, June tends to be the worst month of the year for the Stocks Europe 600, which is like their S&P. And this is over 25 years of data. This is a pretty chunky amount of sample data that we're looking at. So not super interested in Europe here. July could be fun, but June, not so much. Japan is another area where I'm a little bit concerned, mostly because of the runaway action they've seen on their long end. They're trying to foam the runway and get their arms around this, as some of the losses at their insurance companies have been staggering as a result of their long end running away. Because if you think about it, when you buy a bond and that interest rate goes up from where you bought it, that means the price is now lower than where you bought it. So this is a concern both for these Japanese institutions that have a lot of exposure to their treasury paper, just as it is for our own, especially regional banks that have a lot of exposure to treasury paper. And some of that is deeply underwater, as we've seen on some of the FDIC statistics. So not very interested in Japan or Europe here, but I do think there are opportunities elsewhere. One of which is emerging markets. And we saw a really big inflow last week. This was the largest weekly inflow of this year, and I think it's the largest inflow going back to early 2023. There's real interest building in these markets, and some of them look like they have pretty juicy setups. One of them is Vietnam. To me, I like this chart of Vietnam. It looks like it's breaking out and it's ready to continue higher. It's also a beneficiary of some of the reshoring that's happening and some of the relabeling of product that's happening from things moving out of China that need to look like they're not coming from China. But there is real economic growth in Vietnam. This has been a country that I've been watching and researching and trading in and out of for years. And I think we're once again at a time where it makes sense to look at VNM, that Vietnam ETF, for potential swing trade opportunities on this breakout. Another one that I have my eyes on for continuation is Malaysia. I'd like to see it trade above the top of the Ichimoku cloud, but if it did that, I think it'd have room to retest those highs from late last year and possibly continue moving higher. Similarly, it is the beneficiary of some of these reshoring efforts, and it's not the target of Trump's ire. That's really been China. So some of these other countries that have industrial capacity they can bring online, and Malaysia and Vietnam actually do a decent amount of tech manufacturing as well. They benefit from these trends, from this global tension that's largely directed against China. They tend to see more companies wanting to spin up operations there because, you can put a 25% tariff on Apple, as Trump proposed doing. Even if you do that, it's still cheaper to manufacture an iPhone almost anywhere else than here. So you're still going to have, under that same rationale, people that don't want to necessarily deal with the uncertainty of China, and also the government in China is pretty nasty. If you want to manufacture there, they want IP transfer. So you have to surrender your intellectual property rights to their state-owned enterprises, essentially, after a certain period of years. So a lot of reasons not to want to be in China. And I think that some of these other countries can be beneficiaries. Another one is Mexico. Mexico is breaking out. I like the look of this chart. We've pushed above the 21-week moving average and the Ichimoku cloud. We're getting away from that really big area of consolidation. The volume profile, MACD histogram is bullish. I think this one could consolidate a bit here and then continue breaking out and probably get back to last year's highs. And these are stories that don't really get talked about. Who's talking about Vietnam, Malaysia, and Mexico right now? Nobody. I like them more because of that. In fact, I've heard a lot of people talking down about emerging markets, saying there's still no reason to buy any of this stuff. And I'd take the other side of that trade. I'd say for swing trades, if we can capture some gains here, that's really what it's all about, especially if we're able to diversify away from some of the risk we have here at home. Speaking of here at home, however, AMD. This one's been on my radar for a while. I've tried a few times to get long and I usually get stopped out. Sometimes I make a bit of money, but I'm once again getting pulled into the siren song of Lisa Su's AMD. And I really want to see it break above this trend line, this descending trend line. But if it could, I think this one could be a big mover. And it's not just the chart. There are fundamental things happening at AMD that excite me as well. They are eating Intel's lunch in the data center. I mean, absolutely just consuming so much of that server CPU market share, it's not even funny. And they're doing similarly in desktop and mobile compute. So these days, it's much easier to find a computer with AMD CPU, and it's much harder to be disappointed with having a computer that has an AMD CPU. In fact, I'm talking to you from a computer that has an AMD CPU in it right now. Their video cards are also starting to make a bit of a comeback. They're cost competitive with NVIDIA, but they also have some pretty strong offerings out there. But the real key to AMD's success in the future is going to be how they execute in the data center. And we are seeing progress there as well. Now, certainly NVIDIA is still running laps around them in terms of their integration, their CUDA software stack, and some of the networking hardware that really adds to making these implementations kind of like one stop. You go to NVIDIA, you buy their racks and networking gear, you build a data center off of replicating that, all networking it together. AMD doesn't have it to that point yet, but they're trying. Some of their acquisitions and some of the work they've done on ROCm, ROCm, that's their equivalent of NVIDIA's CUDA, the software stack that runs a lot of these AI apps. ROCm's coming along. So I wouldn't count AMD out as a sleeper play, but from a technical basis, I need to see it break this downtrend line. And then silver. Silver has my attention in a big way. And again, I shared the pivot with you earlier, but I'm looking for silver to break above that pivot. And if it can, I think we can get back to some of these highs that we haven't seen in a very long time. I'm still looking for $48 silver again. I'm not sure if that's going to be this year. It really has a lot to do with China and the overall global economy continuing to hum along, China adding some stimulus to the mix. But if that was to be the case, I think silver can make a pretty strong run higher. One thing that folks tend to misunderstand about silver is they tend to look at it primarily as a monetary metal. It's primarily an industrial metal. And once we contextualize it that way and we map it against some of the other industrial metals, it starts to make a lot more sense. So look at silver more as an industrial metal, monetary as a secondary, and if the economies that really use a lot of silver get humming, like China, silver can run. Another area that has my interest here are defensives. Defensives, as a percentage of the S&P 500, are the lowest since 2000. That's healthcare, utilities, and staples as a percentage of the S&P 500. That has me eyeing consumer staples. I think they could be on the cusp of a bigger breakout here. So this is a chart where I both like the technicals, but I also like the contrarian element of it. It's underallocated, it's unloved. A lot of these are very cheap stocks. Many of them pay dividends. So if you don't want to get long XLP itself, look at the ETF's components. There could be some interesting things in there as well. And then finally, Dominion Energy looks interesting to me here as well. There's so much data center construction that's happening in the areas that Dominion serves. And this is a pretty big bullish catalyst for the company over the long term. I also like the chart because it looks like it's starting to break out of that downward trend it's been in. It's above the Ichimoku cloud. We see MACD starting to twist higher, and we see that it's starting to pull above that downward trend line. I'd still like to see it push above this chunky area of the volume profile that promotes consolidation, but overall, I wouldn't mind nibbling on some Dominion shares here. And now, questions and answers. If you folks have any questions about what I've talked about tonight, let me know. I'm happy to address them. And then this recording will be edited and posted. So if you weren't able to see the whole thing or you want to go back through it, it will be around shortly. So I got a great question from my buddy Loves to Spoon saying, do you think crypto has the potential to be the same kind of vehicle that unwinds markets the way the real estate and collateralized debt obligations did during the great financial crisis? So that's a very interesting question. I will say, for one, scale. Back then, the real estate market was dozens of trillions of dollars in size, and the stock market was significantly smaller. Now we have crypto, and let me just, before I put my foot in my mouth, let's just look at the collective crypto market capitalization so I can give you a good number. So that capitalization across all of the crypto that we're aware of is 3.3 trillion. So real estate then versus the stock market then was such a behemoth, and all of that leverage into mortgage-backed securities and other types of debt obligations that keyed off of them, and then the interconnectivity that had to other fixed income and really just global liquidity was, I think, much more systematic and much more risky versus crypto. I think if crypto imploded, it would be bad, would be real bad, and it would largely impact the companies that are in portfolios that are held by folks that are both leveraged long crypto and leveraged long these favorite stocks. These are going to be narrative driven stocks. in my opinion. Things like MicroStrategy obviously have much more direct Bitcoin exposure, so they would really get hit. The crypto miners would really get hit. But I don't think it would be a global systematic financial crisis like we saw in 2008. I think it would be more contained. It would have knock-on impacts for sure, but I think that the scale of impact would be de minimis compared to the real estate debacle. Because at the end of the day, the global stock market is something like, I think, $100 trillion, or maybe it's like, 75, $80 trillion. It's huge. And crypto is like 3.3 trillion in comparison. So even if you liquidated every single thing in crypto down to zero market cap, it would probably be more like a nasty bear market for a couple of months than like, systematic global collapse. But there would be elements that would get hit much harder than others. So I would want to be shying away from anything that was too directly tied to crypto, either from commingling and leveraged portfolios or companies themselves that have direct exposure, or both. Got a question from Shamrock. Shamrock says, do you think the banking cartel is suppressing silver prices? I will say that my own personal thought on this, and I've been in the gold and silver markets for about 19 years now, on and off, trading, investing, etc. I'd say there is funny business that happens. There's spoofing. There's other kinds of nonsense. There's a lot of things that are suspicious that may lead one to believe that there is more suppression of price than would ordinarily happen. But on the other side of it, I think it's very, 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 very important to note this key fact: that the vast majority of short interest that you see in silver are producers selling forward production. So let's say I'm a silver producer and I've got to make sure I can cut paychecks, I can pay for the leases on my mining equipment and my office, and kind of keep everything going. I may not have the cash flow to do that without some kind of advance. So I have choices. I can sell my forward production to a streaming company and take a big haircut on it. I can try to go and raise debt in the market and pay a really high interest rate. I can dilute my shareholders and really anger them as my stock price goes down, or I can sell forward some of that future production, lock in a price that I think is pretty favorable, and access some of that cash. So overall, I would say that silver and gold, they do suffer from funny business and shenanigans, but I don't think that it has the impact that some folks in gold and silver circles seem to suggest. Like the idea that there's going to be this big silver squeeze, it's not really realistic, because most of that short interest are producers that are selling forward production through their banking partners. Because if I am a silver producer and I need to raise that capital and I decide to sell future production, it's going to show up as a short. And it's going to show up on a bank's books, because that's the party that's doing that short for me. But it's not a cash covered short. It's a product covered short, because there's actual silver that's going to be produced that will meet that physical delivery. So there's really not the same kind of dynamic for a squeeze if the folks that are involved with most of the selling forward production or shorting are actually delivering that physical. But I do think that silver is really intriguing here and worth watching, just for more reasons that rely on supply and demand and technicals than, short squeezes. Okay, so we got two questions about the S&P 500 that I think I can answer with the same answer. I'm just going to read off the first two questions. I missed the initial minutes. Do you think the S&P 500 continues its current bullish trend moving forward? And then another question, market almost at all-time high. What is your prediction for the rest of the year? So these are kind of veering in the same direction. I would say that S&P 6000 is a really important level to watch. And let me see if I can go back and get this chart for you guys. So if we look at S&P 6000 here, this is kind of the line in the sand that the options market has drawn. So what I'd really like to see is a rally above it on a weekly closing basis. We're getting closer to OPEX in June. So what I believe will happen leading into that is we'll probably get more magnetically pulled into 6,000 and stuck there, clenched by gamma until post options expiration. After that, I think we have more room for price discovery. And if we can build acceptance higher than 6,000 on a weekly closing basis, we absolutely have the potential to test those all-time highs and possibly make new ones. On the other side of it, if we do get rejected there and it's a meaningful rejection, we've got some room lower. We've had this huge, unforgiving nosebleed type of move off the lows. It wouldn't be unhealthy to see some kind of corrective selling before that momentum continues higher. Another thing that I shared earlier was this chart. So if there's no sell in May, there's no need to go away. When May has 5% or higher of a rally month over month, the average return over the next year is almost 20%. So there's not a lot here to hate about the market. I think that it really is going to have to do over the summer with making some progress on these trade deals or just backing away from the trade war entirely, which has kind of been more and more what seems to be happening. But that would remove some of the uncertainty that had been dampening bullish animal spirits. Obviously, they've come back out, and part of that is the taco trade. Trump always chickens out. No one believes him anymore, and it's hard to really blame people at this point. Victor says the king is back. Victor, that's far too kind. I appreciate you. All right, folks, we're going to cap it here. I'm going to chop up the recording and post it online so y'all can check that out. Really appreciate you all tuning in. I'll be back first week of July on Wednesday for navigating the markets. I'll put that all out there on the schedule. It's going to be the first Wednesday of every month that I do these videos. So thanks for tuning in. Look forward to catching you next time.
Markets and mayhem in the markets, marking the mayhem. You are now the target.